Welcome to our channel. Today we're diving into some essential saving strategies that everyone should know about. Seriously, if you're looking to get your finances in order, build some security, and maybe even start thinking about bigger goals, then understanding how to save effectively is non-negotiable. It's the bedrock of a solid financial future, and too many people overlook the basics or think it's too complicated. Trust me, it's not, and I'm here to break it down for you step by step so you can start making real progress. We're going to cover everything from where to stash your cash safely while earning a bit of interest, to building that all-important safety net for when life throws you a curveball. And believe me, it will. Then, we'll look ahead and talk about planning for the long term, making sure you're set up for a comfortable future down the road. These aren't get-rich-quick schemes. These are tried-and-true methods that work, and I'm excited to share them with you. So, grab a notepad, maybe a cup of coffee or an iced coffee if you're like me, and get ready to learn how to master your money. By the end of this video, you'll have a much clearer picture of how to make your savings work for, not the other way around. Let's get right into it, because your financial journey starts now, and these strategies are going to be game changers. All right, let's kick things off with the absolute foundation of smart saving, the humble savings account. Now, I know what some of you might be thinking. Graham, a savings account? Isn't that, like, super basic? And you'd be right, it is basic, but basic doesn't mean unimportant. In fact, it's one of the most crucial first steps you can take on your path to financial wellness. It's the training wheels for your money management bicycle, helping you get moving in the right direction without falling flat on your face when you hit a bump. So, what exactly is a savings account? Simply put, it's a deposit account held at a bank or other financial institution that allows you to store your money securely while typically earning a modest amount of interest. Unlike your checking account, which is designed for frequent transactions like paying bills or everyday spending, a savings account is really meant for, well, saving. It's a place to park cash that you don't need immediate access to for daily expenses, allowing it to grow, even if just a little, and be there when you need it for specific goals or emergencies. One of the biggest, and I mean benefits of using a savings account, especially one from a reputable bank or credit union, is security. In the United States, for example, if your bank is FDIC insured, your deposits are protected up to $250,000 per depositor per insured bank for each account ownership category. Credit unions offer similar protection through the NCUA. This means that even if the bank were to fail, which is rare but possible, your hard-earned savings are safe. This peace of mind is invaluable, especially when you're just starting out. Then there's the interest component. Now, let's be real, the interest rates on traditional savings accounts from big brick-and-mortar banks haven't always been something to write home about. Sometimes they're laughably low. However, the principle remains. Your money is working for you, earning more money over time, even if it's just a few dollars a year to start. It's about establishing that habit, that mindset of having your money generate returns. This is your first taste of passive income, however small. But here's where it gets interesting. High-yield savings accounts, or HISAs. These are often offered by online banks, which have lower overhead costs and can pass those savings onto you in the form of much better interest rates. We're talking rates that can be significantly higher than what you'd find at your local physical branch. Suddenly, that modest interest can become a bit more meaningful, helping your savings grow at a faster pace and at least try to keep up with inflation, which is always a concern we need to be mindful of. Let's talk about how that interest actually works. Most savings accounts use compound interest. This is where the magic happens, folks. Compounding means you earn interest not only on your initial deposit, your principal, but also on the accumulated interest from previous periods. So, your interest starts earning interest. It's like a snowball rolling downhill, getting bigger and bigger over time. The longer you leave your money to grow and the higher the interest rate, the more powerful this effect becomes. It's a beautiful thing. Accessibility is another key feature. While a savings account is designed to keep your money a little separate from your daily spending cash in your checking account, you still need to be able to get to it when necessary. Most savings accounts allow you to withdraw or transfer money relatively easily, either online through an app, at an ATM, or by visiting a branch if it's a traditional bank. This makes them ideal for short-term goals or for housing your emergency fund, which we'll talk more about later. However, it's worth noting there used to be something called Regulation D, which limited you to 6 certain types of withdrawals or transfers from a savings account per month. While the Federal Reserve has currently lifted this limit due to the pandemic, some banks might still have their own policies or could reinstate limits in the future. It's always good to check the terms and conditions of your specific account so you're not caught off guard by unexpected fees or restrictions. Always read the fine print, people. The psychological benefit of having a separate savings account cannot be overstated. When your savings are mixed in with your checking account, it's so easy for that money to just get absorbed into everyday spending. Oh, I have a few extra hundred in my checking. I can afford that new gadget. By physically or digitally separating your savings, you create a mental barrier. You're less likely to dip into it impulsively. It's earmarked, it has a purpose, and that makes all the difference in actually achieving your savings goals. When you're choosing a savings account, don't just go with the first bank you see or the one your parents used. Shop around. Compare interest rates. Look for those HOSAs I mentioned. Check for monthly maintenance fees. Ideally, you want an account with no fees, or fees that are easily waived, perhaps by maintaining a minimum balance or setting up automatic transfers. Some accounts might have minimum opening deposit requirements, so factor that in as well. Use bank comparison websites to make this process easier. Consider the features that matter to you. Do you prefer an online-only bank for potentially higher rates, or do you value the ability to walk into a physical branch? How good is their mobile app? What are the customer service options like? These might seem like small details, but they can impact your overall banking experience. You want managing your savings to be as smooth and hassle-free as possible, so you actually stick with it. Automating your savings is a pro tip, and savings accounts make this super easy. You can set up recurring automatic transfers from your checking account to your savings account on payday. This pay-yourself-first strategy ensures that you're consistently putting money aside before you even have a chance to spend it. It could be $20 a week, $100 a month, whatever you can afford. The key is consistency. Before you know it, those small regular deposits will add up to a significant sum. Savings accounts are perfect for specific short-term goals. Maybe you're saving for a down payment on a car, a vacation, a new computer, or even just building up a buffer for unexpected expenses. By having a dedicated savings account or even multiple savings accounts nicknamed for each goal, you can track your progress and stay motivated. It's incredibly satisfying to see those balances grow and know you're getting closer to what you want. Now, we do need to touch on inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. If your savings account interest rate is lower than the rate of inflation, your money is technically losing a tiny bit of its buying power over time. While HISAs can help combat this better than traditional accounts, savings accounts are generally not meant for long-term wealth to beat inflation significantly. That's where investing comes in. However, for safety, liquidity, and short-term goals, savings accounts are unbeatable. They are the essential first step. Think of it as your financial launchpad. You need a stable base before you can shoot for the stars with investments. Without a solid savings habit and a secure place to keep your foundational cash, you're building your financial house on shaky ground. Don't skip this step seriously. You might also hear about money market accounts, MMAs. These are similar to savings accounts. They're deposit accounts that often offer slightly higher interest rates than traditional savings accounts and may come with check writing privileges or a debit card, offering a bit more flexibility. They are also typically FDIC or NCUA insured. Sometimes the minimum balance requirements for MMAs are higher, so compare them carefully with HYSAs to see what makes the most sense for your situation. Ultimately, opening and consistently funding a savings account is about discipline, security, and setting yourself up for success. It's about taking control of your money and making it work for you, right from the very beginning. It's a simple tool, but its impact on your financial health can be profound. So if you don't have one, or if you're not actively using yours, make that your homework after watching this video. Get it set up, automate those deposits, and watch your financial confidence grow. Okay, so we've talked about savings accounts as a general tool. Now let's get specific and discuss one of the most critical uses for that savings account, building an emergency fund. If there's one piece of financial advice that I hammer home constantly, it's the importance of having an emergency fund. This isn't just a nice to have. In my book, it's an absolute non-negotiable necessity for everyone. It's your financial lifeline. So what exactly is an emergency fund? It's a stash of money set aside specifically to cover large, unexpected expenses or to help you get by if you suddenly lose your income. Think of it as your personal financial safety net. It's the buffer between you and potential financial disaster when life decides to throw one of its infamous curveballs. And trust me, life is an expert pitcher when it comes to curveballs. You never know when one is coming. Why is it so incredibly crucial? Well, imagine this. You lose your job unexpectedly, or your car breaks down and needs an expensive repair. Or you're hit with a surprise medical bill. Without an emergency fund, how do you cover these costs? Many people resort to high-interest credit card debt, personal loans, or even borrowing from retirement accounts, all of which can have devastating long-term financial consequences. An emergency fund prevents you from having to make these desperate, costly decisions. Let's list some common examples of what constitutes a true emergency, the kind of thing this fund is designed for. We're talking about job loss, which is a big one, giving you breathing room to find new employment without panicking, medical or dental emergencies that aren't fully covered by insurance, urgent home repairs like a burst pipe or a broken furnace in the middle of winter, unexpected car repairs that are essential for you to get to work. These are the uh-oh moments where having cash on hand is a lifesaver. The psychological impact of having an emergency fund can be immense. Living paycheck to paycheck, constantly worried about what might go wrong, creates a huge amount of stress and anxiety. This financial insecurity can affect your health, your relationships, and your ability to make clear-headed decisions. Conversely, knowing you have a cushion, a financial shield, provides incredible peace of mind. It allows you to navigate unexpected challenges with a sense of calm and control, rather than fear and desperation. Now for the big question. How much should you actually save in your emergency fund? The general rule of thumb, and you've probably heard this before, is to aim for 3 to 6 months' worth of essential living expenses. This is a guideline, of course, and the ideal amount for you might vary, but it's a fantastic starting point. This isn't 3 to 6 months of your, mind you, but 3 to 6 months of what it actually costs you to live. So, what expenses should you include in this calculation? You'll want to tally up all your monthly costs. This includes things like your rent or mortgage payment, utilities, electricity, water, gas, internet, food, transportation costs, gas, public transport, insurance premiums, health, car, home, and any minimum debt payments you have. Non-essentials like entertainment, dining out, or subscriptions can often be cut back in a true emergency, so focus on the bare necessities for survival. Why the range of 3 to 6 months? Well, several factors can influence whether you should lean towards the lower or higher end of that spectrum, or even beyond. If you have a very stable job in a high-demand field and few dependents, 3 months might be adequate. However, if your income is variable, you work in a less stable industry, you have a family to support, or you have significant medical concerns, aiming for 6 months or even more provides a much more robust safety net. Consider your personal risk factors. Where should you keep this emergency fund? This is where your high-yield savings account, which we discussed in Chapter 1, comes into play perfectly. You want the money to be safe, easily accessible in a true emergency, but not accessible that you're tempted to dip into it for non-emergencies. An online HOSA is often ideal because it usually offers better interest rates than traditional accounts, helping your fund at least try to keep pace with inflation, and it's separate from your everyday checking. The key is balancing accessibility with the temptation to spend. You don't want it locked away in investments where you might incur penalties or have to sell at a loss to access it quickly, but you also don't want it sitting in your checking account where it can easily get spent on a whim. A separate, clearly labeled savings account, emergency fund, do not touch, is the way to go. Make it feel off limits for anything but a genuine crisis. Building up an emergency fund, especially if you're aiming for 6 months of expenses, can feel like a daunting task. Don't let that overwhelm you. The key is to start small and be consistent. Even if you can only put aside $25 or $50 a week, do it. Automate those transfers from your checking to your emergency savings account right after you get paid. Treat it like any other essential bill. Every little bit adds up, and you'll be surprised how quickly it can grow over time. It's also really important to be clear about what an emergency fund is for. It's not for a down payment on a house, that's a separate savings goal. It's not for a planned vacation. It's not for buying the latest iPhone or a new TV. It's not for covering a bad investment. Using your emergency fund for these types of planned or discretionary expenses defeats its entire purpose and leaves you vulnerable when a real crisis hits. Discipline is key here. The feeling of security that a fully funded emergency fund provides is truly priceless. It's like having a financial superhero cape. You walk a little taller, you sleep a little sounder, knowing that if something unexpected happens, you're prepared. You're not going to be immediately derailed or forced into making bad financial choices out of desperation. This confidence can spill over into other areas of your life, allowing you to take calculated risks, like pursuing a new career path, knowing you have a buffer. And what happens if you do have to use a portion of your emergency fund? First, don't beat yourself up. That's exactly what it's there for. The crucial next step, however, is to make replenishing that fund your absolute top financial priority. Pause other savings goals or discretionary spending if necessary and aggressively rebuild that safety net as quickly as possible. You never know when the next emergency might strike, so getting back to your target amount is paramount. It's also a good idea to periodically review and adjust the size of your emergency fund. Life changes. Your expenses might increase if you move to a more expensive area, have a child, or take on new financial responsibilities. Your income or job stability might change. Aim to reassess your emergency fund target at least once a year or after any significant life event to ensure it still adequately meets your needs and provides that essential layer of protection. One common mistake people make is either not starting an emergency fund at all, thinking they'll never need it, or they start one but keep it in cash under the mattress. Cash under the mattress earns no interest and is vulnerable to theft or loss in a fire or flood. Another mistake is investing it too aggressively, hoping for higher returns, but then risking its value or accessibility when it's needed urgently. Remember, the primary goal of an emergency fund is safety and liquidity, not high growth. It's also important to differentiate your emergency fund from your general savings. You might have other savings goals, like saving for a car, a vacation, or a down payment on a home. These should ideally be in separate savings accounts or buckets so you can track progress for each and not confuse them with your emergency money. Your emergency fund is sacred. It's the one you touch only when absolutely necessary. Finally, understand that having a robust emergency fund is what allows you to invest for the long term with more confidence. If you have your short-term needs and potential crises covered, you're less likely to have to panic sell your investments during a market downturn if you suddenly need cash. It protects your long-term wealth-building strategy. It truly is the cornerstone of a sound financial plan, so make building and maintaining yours a top priority. All right, we've covered the short-term safety of savings accounts and the crucial protection of an emergency fund. Now, let's shift our gaze further into the future and talk about something incredibly important for your long-term financial well-being: retirement accounts. I know retirement can feel like a lifetime away, especially if you're young, but trust me on this one, the sooner you start, the better off you'll be. Time is your greatest ally here. Why even bother saving for retirement? Well, unless you plan on working until the day you drop, or you're independently wealthy already, in which case, congratulations. You're going to need a way to support yourself when you're no longer earning a regular paycheck. People are living longer than ever before, and the traditional idea of pensions is becoming increasingly rare. Social Security is a helpful supplement, but for most, it won't be enough to maintain their desired lifestyle. You need to take control of your own future. The magic of retirement accounts often lies in their tax advantages. Governments typically offer these incentives to encourage people to save for their own retirement, reducing the burden on social safety nets later on. These tax breaks can come in a few different flavors, like tax deductions on your contributions now, tax-deferred growth, meaning you don't pay taxes on the investment gains until you withdraw the money in retirement, or even tax-free withdrawals in retirement. These benefits can significantly boost your savings over decades. Let's start with one of the most common types of employer-sponsored retirement plans, the 401k. If your employer offers one, you should definitely pay close attention. A 401k allows you to contribute a portion of your paycheck directly into an investment account, often before taxes are taken out. This pre-tax contribution reduces your current taxable income, which is a nice immediate benefit. The money then grows tax-deferred until you retire. One of the absolute best features of many 401k plans is the employer match. This is literally free money, people. I can't stress this enough. If your employer offers to match a certain percentage of your contributions, for example, matching 50% of what you contribute up to 6% of your salary, you should do everything in your power to contribute at least enough to get that full match. Not doing so is like turning down a guaranteed return on your money. It's just leaving cash on the table. Many 401k plans now also offer a Roth 401k option. With a Roth 401k, your contributions are made with money you've already paid taxes on, post-tax. The amazing benefit here is that your investments grow tax-free, and then, when you take qualified withdrawals in retirement, you pay absolutely zero taxes on that money, not on your contributions, and not on any of the earnings. This can be incredibly powerful, especially if you expect to be in a higher tax bracket in retirement. It's important to understand vesting schedules if your employer offers matching contributions. Vesting refers to how long you need to work for the company before that matching money is truly yours. For example, a company might have a cliff vesting schedule where you're 0% vested for 2 years, then 100% vested after that. Or they might have a graded schedule where you become gradually vested over several years. If you leave before you're fully vested, you might forfeit some or all of the employer match, so be aware of your company's policy. Within your 401k, you'll typically have a menu of investment options to choose from, often a selection of mutual funds or exchange-traded funds, ETFs. These can range from stock funds to bond funds to target date funds, which automatically adjust their risk level as you get closer to retirement. It's important to understand these options and choose a diversified portfolio that aligns with your risk tolerance and time horizon. Don't just pick randomly or leave it all in cash. Now, what if you don't have a 401k through your employer, or you want to save even more for retirement? That's where individual retirement accounts, or IRAs, come in. These are accounts you can open on your own through a brokerage firm or bank. There are two main types, the traditional IRA and the Roth IRA, and they have different tax treatments that mirror the pre-tax and post-tax options of 401ks. With a traditional IRA, your contributions may be tax-deductible in the year you make them, depending on your income and whether you're covered by a retirement plan at work. This means you could lower your current tax bill. The investments within the traditional IRA then grow tax-deferred, and you'll pay ordinary income tax on all withdrawals you make in retirement, both contributions and earnings. This can be beneficial if you expect to be in a lower tax bracket in retirement than you are now. The Roth IRA, on the other hand, is a personal favorite for many, especially younger folks or those who anticipate being in a higher tax bracket later in life. Contributions to a Roth IRA are made with after-tax dollars, so there's no upfront tax deduction. However, the magic happens when your investments grow completely tax-free and all qualified withdrawals in retirement. Again, both your contributions and all those lovely earnings are 100% tax-free. That tax-free growth and withdrawal feature is incredibly powerful over the long term. Both traditional and Roth IRAs have annual contribution limits set by the IRS, which can change periodically. For 2023, for example, the limit is $6,500 or $7,500 if you're age 50 or older, allowing for catch-up contributions. It's important to note that Roth IRAs also have income limitations. If your modified adjusted gross income is too high, you might not be able to contribute directly to a Roth IRA, though there are strategies like the backdoor Roth IRA that can sometimes be used. There's also something called a spousal IRA, which allows a non-working or low-earning spouse to save for retirement in their own IRA, provided the couple files taxes jointly and the working spouse has enough earned income to cover the contributions for both. This is a great way to ensure both partners are building a retirement nest egg, recognizing the valuable contributions of a stay-at-home partner. The core benefit across these retirement accounts, whether it's a 401k or an IRA, traditional or Roth, really boils down to those powerful tax advantages. By either deferring taxes or eliminating them entirely on growth and withdrawals, these accounts allow your money to compound much more effectively over the decades leading up to retirement. You're essentially getting a boost from the government to help you save. The power of compound interest, which we touched on with savings accounts, becomes truly explosive when applied over the 20, 30, or even 40-plus years you might be saving for retirement, especially within a tax-advantaged account. Starting early, even with small amounts, can make a monumental difference due to this compounding effect. Someone who starts saving in their 20s will likely end up with significantly more than someone who starts in their 40s, even if the late starter contributes more annually. Time is your superpower here. So, how do you choose between a 401k and an IRA, or decide if you should use both? If your employer offers a 401k with a match, your first priority should generally be to contribute enough to get that full match. It's free money. After that, the decision can depend on factors like the quality of investment options and fees in your 401k versus what you could get in an IRA, and your preference for pre-tax versus Roth contributions based on your current and expected future tax situation. Many people contribute to their 401k up to the match, then max out a Roth IRA, then go back to the 401k if they can save more. For those who are self-employed or small business owners, there are other types of retirement accounts to consider, like SEP IRAs, Simplified Employee Pension, or Simple IRAs, Savings Incentive Match Plan for employees. These also offer tax advantages and are designed to make it easier for small businesses and sole proprietors to save for retirement. It's worth researching these if they apply to your situation. One crucial aspect to always be mindful of with any investment account, including retirement accounts, is fees. Fees can eat into your returns significantly over the long term, so understand what you're paying for. Expense ratios on funds, account maintenance fees, advisory fees. Opt for low-cost investment options whenever possible, like index funds or ETFs, as this can save you tens or even hundreds of thousands of dollars over your investing lifetime. Every fraction of a percent matters. Finally, if you change jobs, you'll need to decide what to do with your old 401k. You typically have a few options. You can sometimes leave it with your old employer, if the balance is high enough. You can roll it over into your new employer's 401k if they allow it. You can roll it over into an IRA, which often gives you more investment choices and control. Or you could cash it out, which is generally a terrible idea due to taxes and penalties. A direct rollover to an IRA is often a very smart move. Take retirement savings seriously. Your future self will thank you profoundly. So there you have it, a deep dive into some of the most fundamental saving strategies, leveraging savings accounts, building that crucial emergency fund, and getting started with retirement accounts. These aren't just abstract concepts. They are actionable steps you can take right now to significantly improve your financial health and security. Remember, mastering your money is a marathon, not a sprint, but by implementing these strategies, you're building an incredibly strong foundation for whatever financial goals you have. The key takeaways are to be intentional with your money. Make saving a priority and understand the tools available to you. Whether it's finding a high-yield savings account to make your cash work a little harder diligently, building up that 3 to 6 months of emergency expenses for peace of mind, or taking advantage of the powerful tax benefits of retirement accounts to secure your future, every step you take matters. Don't get discouraged if you can't do everything at once. Start small, be consistent, and celebrate your progress along the way. Thanks for watching. Don't forget to like, subscribe, and hit the notification bell for more financial tips and strategies. We're here to help you on your journey to financial freedom, and we've got a lot more content planned to help you do just that. If you have any questions or topics you'd like us to cover in future videos, please drop them in the comments below. We love hearing from you. Now go out there and start mastering your money.